What's up guys and welcome to Wall Street Millennial. On March 17th, the US Federal Reserve announced that while they do see the economy gradually starting to recover, they plan to keep interest rates anchored near 0% for the foreseeable future. This is a big deal for the markets and suggests that the massive rally in tech stocks that we've seen in 2020 is likely to continue into 2021. In this video, we will go over the most important things the Fed Chair Jay Powell said in his address and what it means for the stock markets going forward. The massive rally we've seen in stocks during the pandemic have largely been driven by the Federal Reserve's massive policy response. The Fed has printed trillions of dollars and set interest rates to 0%, and investors were left flush with cash, with bond yields not offering an attractive alternative. Investors then put their money into the stock market, pushing up prices to record levels. But with the economy expected to recover in 2021 on the back of vaccine rollouts, many investors fear the Fed will end their accommodative monetary policies. This could cause interest rates to shoot up and the stock market to crash back to more normal levels. In fact, we've already seen the beginnings of this in late February of this year, as the tech-heavy Nasdaq corrected down by more than 10%. This sell-off was triggered by a sharp increase in the 10-year Treasury bond yield, which skyrocketed by more than 90% from 0.9% to 1.7%. But why does the 10-year Treasury yield impact the stock market, and why were tech stocks the hardest hit by the sell-off? It all boils down to how stocks are discounted with a DCF. Stocks are generally valued based on the discounted value of their future cash flows, so the lower the discount rate, the higher the discounted value. High-growth stocks are more sensitive to changes in the interest rates than low-growth stocks, as we'll see here with a simple example. Say you have two companies, one is a high-growth tech stock and the other is a dying brick-and-mortar retailer. The tech company starts off with very little cash, but it increases quickly at 50% a year. The retailer starts off with very high cash flow, but it decreases 20% per year. If we apply a 10% discount rate over the next 5 years, the tech stock's present value is $92.88, while the retailer's present value is $106.20. Now let's assume the Fed raises interest rates, which increases our discount rate from 10% to 20%. This decreases the discounted value of the cash flows of both companies, but because the tech company's cash flows are more heavily weighted towards the future, the present value of the tech company decreases by 26%, while the present value of the retailer only decreases by 18%. So while high interest rates negatively impact all stocks, the high-growth tech stocks are the hardest hit. So the Fed's recent decision to not hike rates is good for the stock market and especially good for tech stocks. Now we'll go over some of Jerome Powell's remarks about the Fed's decision to keep rates low.
Today, the FOMC kept interest rates near zero and maintained our sizable asset purchases. These measures, along with our strong guidance on interest rates and on our balance sheet, will ensure that monetary policy will continue to deliver powerful support to the economy until the recovery is complete. The path of the economy continues to depend significantly on the course of the virus and the measures undertaken to control its spread. Since January, the number of new cases, hospitalizations, and deaths has fallen, and ongoing vaccinations offer hope for a return to more normal conditions later this year. In the meantime, continued observance of social distancing measures and wearing masks will help us reach that goal as soon as possible. The economic recovery remains uneven and far from complete, and the path ahead remains uncertain. Following the moderation in the pace of the recovery that began toward the end of last year, indicators of economic activity and employment have turned up recently, although the sectors of the economy most adversely affected by the resurgence of the virus and by greater social distancing remain weak. Household spending on goods has risen notably so far this year. In contrast, household spending on services remains low, especially in services that typically require people to gather closely, including travel and hospitality.
While some parts of the economy, such as housing, have recovered strongly, the leisure, hospitality, and travel sectors still have a long way to go before recovering to pre-pandemic levels. Importantly, Jay Powell is signaling that they will keep rates low until the lagging parts of the economy recover, which will take a long time.
Overall inflation remains below our 2% longer-run objective. Over the next few months, 12-month measures of inflation will move up as the very low readings from March and April of last year fall out of the calculation. Beyond these base effects, we could also see upward pressure on prices if spending rebounds quickly as the economy continues to reopen, particularly if supply bottlenecks limit how quickly production can respond in the near term. However, these one-time increases in prices are likely to have only transient effects on inflation.
As the vaccines roll out, there will be a great deal of pent-up demand as people are finally able to go to shopping malls, etc. At the same time, the pandemic's side effects are still lingering throughout the international supply chains. This combination of factors will likely lead to temporarily high inflation numbers in the first half of 2021. Powell is reassuring investors that these transitory inflation pressures will not cause the Fed to raise rates, which is a big reassurance.
As the committee reiterated in today's policy statement, with inflation running persistently below 2%, we will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time and longer-term inflation expectations remain well anchored at 2%. We expect to maintain an accommodative stance of monetary policy until these employment and inflation outcomes are achieved.
This is a very important point in the press conference. Powell is saying that they will target higher inflation in the coming months and even years as compared to the very tame inflation that we've seen since the financial crisis of 2008. The Fed usually targets inflation of around 2% over long periods of time in order to provide price stability and facilitate economic growth. However, in the past decade, in most years inflation has stayed below this target. The Consumer Price Index is a weighted average of prices for a basket of goods that the Fed keeps track of as a measure of inflation. You can see from this chart that it has been slightly below normal levels in the past decade. The fact that the Fed will be targeting elevated inflation in the future is actually beneficial for certain sectors of the economy. The main beneficiaries will be industries who have high multiples due to expectations of future growth, as well as industries that produce commodities. Industries with expectations of future growth, such as tech, will benefit because their future earnings will be higher due to inflation increasing the prices that they will sell their products at. Commodities producers will also benefit because commodities prices respond very quickly to inflation, while labor costs respond more slowly.
With regard to interest rates, we continue to expect it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. I would note that a transitory rise in inflation above 2%, as seems likely to occur this year, would not meet this standard. In addition, we will continue to increase our holdings of Treasury securities by at least $80 billion per month and of agency mortgage-backed securities by at least $40 billion per month until substantial further progress has been made toward our maximum employment and price stability goals. The increase in our balance sheet since last March has materially eased financial conditions and is providing substantial support to the economy. The economy is a long way from our employment and
What Powell said in this section is huge for the economy and for markets. Not only did he say that the Fed will continue buying Treasury bonds at an accelerated rate, but that a moderate short-term spike in inflation will not be enough for them to stop their purchase programs. The Fed's dual mandate is to pursue both maximum employment in the economy and price stability. Powell is basically saying that in the committee's view, these goals will not be achieved unless they continue massive quantitative easing, or in other words, money printing. As a result, there will be no rate hikes for a significant amount of time.
As much advance notice of any potential taper as possible. So when we see that we're on track, when we see actual data coming in that suggests that we're on track to perhaps achieve substantial further progress, then we'll say so. And we'll say so well in advance of any decision to actually taper.
This is an important point because it helps alleviate fears of any unwarned rate hikes taken by the Fed. Hopefully this will prevent any flash sell-offs in the market due to Fed announcements even once they do scale down quantitative easing. One of the biggest things that spooks markets is uncertainty and sudden changes in economic or political landscapes that have importance to future cash flows. A sudden hike in interest rates by the Fed would definitely qualify as that, so Powell's comments are basically serving to quell fears that they will do anything without warning. So overall, the press conference was very favorable for certain sectors of the stock market, and was in general good for the market in the short term as a whole. Printing money and basically just giving it to the markets is obviously going to be good for stocks, and Powell basically said to not expect it to end anytime soon. That is why the market spiked during the press conference, although they soon fell back down over the course of the next day. We all know that markets can be fickle in the short term, but what the Fed said in this announcement will help to boost the economy in the next several years. For most investors long the market, this announcement was good news. Alright guys, that wraps it up for this video. If you liked the content, make sure to hit that like button and subscribe for future videos. Also check us out on TikTok and Instagram, and subscribe to our second channel, WSM Research. In the meantime, thank you so much for watching and we'll see you in the next video. Wall Street Millennial, signing out.